And it's such a massive shift because the banks and the government have spent so many years and so many billions of dollars on advertising to keep the middle class down. Mm-hmm. That's why we see the gap between the middle class and the wealthy growing, right? They'll blame it on the wealthy, but it's not. It's the banks and the government that are keeping people trapped in that scarcity mindset. You know who made it.
Welcome back to the Wealth Easy Show, where we talk all things wealth, health, and real estate. Today, I've got a little bit of a different venue. We're going to be doing a roundtable discussion today with Michael Brooks, a mortgage broker who you might remember has been a previous guest on the show, and Robert DiPaolo from Manulife. And today, we're going to discuss how you can pay off your home in 7 to 10 years with the Manulife One product. Welcome, guys.
Thanks for having us.
Robert, thank you for being here. Why don't you just give us, both of you, just give us a 2-minute bio on yourself. Why don't you go ahead, Robert?
So I've been in the financial industry for 32 years. I spent the first half of it selling overpriced mutual funds and realized that's something I just didn't want to do anymore. I just didn't really like that side of things. I really thought lending was to do complete financial planning, you really have to look at assets and liabilities. So then I spent the second half doing mortgages with one of the largest monolines in the country, and now with Manulife Bank.
Wonderful. And Michael?
Yeah, I've been a mortgage broker for 15 years, doing mortgages with Rock Capital Mortgage, the mortgage center, and just been growing and learning how to invest in tax-free products like the life insurance that you deal with, and learning how to teach people about the Manulife One strategy, and just setting myself apart by looking at the holistic approach and trying to move people forward in life to develop that multi-generational wealth as opposed to just a transactional mortgage broker.
Amazing, amazing. Robert, why don't you give us a brief overview for people who don't know what the Manulife One product is? Why don't you just give us a brief explanation and how it differs from traditional mortgage products? Because it's very different from the traditional product out there when people go into a bank and ask for a mortgage.
Yeah, it's completely different. I think the easiest way to describe Manulife One is a bank account with a very large overdraft that happens to contain your mortgage. And then any other room you have, you use it as a fully functioning checking account. And that's it. If you use it properly, you can create all kinds of wealth. You can pay your mortgage off faster. You can use it to buy other investments if you'd like. But it's really designed to be put into a HELOC, which is the fully functioning checking account. We do have sub-accounts as well. You can have 1 to 5 year terms if you'd like. I think of the sub-accounts or the amortizing portions, I think of them as training wheels. Because if the cash flow is really, really good for the client, if I put them in an amortizing mortgage, I'm slowing them down, I'm costing them money. Doesn't matter what the rate is. So this is a function of income and expenses. Rate is really irrelevant with this product when you have the right client.
So in a traditional mortgage, for people who don't understand, because there's a lot of people who really don't understand how a mortgage works, the interest is mostly calculated up front. So if you have a 25-year amortization, the bank is going to calculate most of the interest all up front. So in, say, the first 8 to 10 years, really the chunk of your payment is actually going toward interest. It's calculated first. That is different with the Manu One product because this is more of a daily interest and it's not calculated in advance, correct?
Correct. With a regular mortgage, you're right. 7 to 10 years, you're mainly, there's always going to be a component of interest and principal. The first 7 to 10 years is mainly interest. With a Manulife One, it's all principal from day one. Every time you get paid, all of that principal, because it's a bank account, $5,000 goes into the account, your principal drops by $5,000. There's no part interest, part principal. And that's the beauty of this program. There's no speed limits to this. You can pay it off as quickly as you want, access the funds whenever you want. It really is designed for people that are good with their money, high income earners that are very good with their money.
So Rob, explain a little more about that concept of a bank account. I know people get hung up on that because they think of this as a HELOC when it's registered against their house, just like any other, like a Scotia HELOC or something like that. Just expand a little bit on that concept of banking, because people get confused when they think they have to switch over all their banking to the Manulife One, which is the concept of it. So just expand on that a little bit for us.
Yeah, that's the biggest challenge is people say, oh, I like my bank. I don't want to move everything over. I've been with this bank for 30 years. We don't require you to move your banking over 100%. What we do is we let you link any account you want to your Manulife account. So you can pull money in from Scotia or TD or Royal, wherever you bank. You can pull it into your Manulife account, or you can push money from your Manulife account to these other accounts. So you don't have to get rid of it. You can transition over time. I think people will realize that the Manulife account works really, really well because you become your own banker. There's no need to put money in your bank account and just let it sit there. What I say to people, when you deposit money into your bank account, you've made an interest-free loan to the bank, because they take your money, they lend it out to other people, they'll lend it back to you. But when you have a Manulife One, you become your own banker, because we're going to reduce the principal with each payment, right? Every time you get paid, we're going to knock that principal down by that amount. The more you can leave money in your account, the faster you're going to pay it off.
So for example, if I had a $500,000 mortgage on June the 1st, and my wife and I, we get our paychecks, and let's say it's 10 grand, and all that $10,000 goes in there. Let's say it's every 2 weeks. So I'm only really paying the interest on, say, $490,000 until I actually draw again from that.
Correct. We calculate it daily. So if you had a $500,000 mortgage, 10,000 went in on that day, we're going to calculate it at 490. We charge monthly, simple interest charge monthly, but we calculate daily. So again, if you leave the money in there, you're going to pay your principal down much faster. But people have to pay bills. So money's going to go in, money's going to go out, because it's a fully functioning checking account. Right. And at the end of,
there's a key word that you said: simple interest.
Simple interest. If you understand, that's why the banks are great investments, because it's compound interest on top of interest, right? Everyone should own the banks. They're great investments. We have some of the best banks in the world, right? We have a really, really strong banking system. But when you don't understand compound interest, you're paying it. When you understand it, you're earning it. And with a Man One, it's simple interest. There's no compounding effect to it. And that's what makes it so powerful when the client when they're cash flowing, when they have great cash flow every month. And the numbers that I like to see are 2 to 1. If I'm bringing in $20,000 a month and I'm spending $10,000 a month, that's $10,000 a month that's being knocked off of my principal. That's $120,000 a year. How quickly do you think you're going to pay a mortgage off? Doesn't matter what the size of the mortgage is. When your cash flow is good, we can cut that amortization down from 25 years to 10 years or less if the cash flow is really good.
And that's amazing. And because there's a lot of people that don't understand, basic mortgages. And for the people listening, you have to understand mortgages are compounded semi-annually. This product is simple interest. It's daily simple interest. So if you can keep paying this thing down and say pay your bills at the end of the month, all of that, those days, let's say it's 25 days, you're going to be paying simple interest on that balance. And like Robert said, you can really knock a good 10 to 15 years off if you are being an honest banker and you're being honest with it. Don't dive into it and use it for consumerism.
Yeah, that's like one of the biggest things to get across to people. Just because you now have this product as your bank account, and like Robert said, think of it as a bank account with a giant overdraft. Don't just go and freely spend on all kinds of consumer stuff, right? All the garbage that people spend it on. Yeah. You still have to be diligent at maintaining that income to expense ratio. I know you said 2 to 1, Robert, but we've seen it work even with about a 25% income to expense ratio, and it really cuts it down. I saw a lady just recently I did one for. It took her from 33 years paying off all of her mortgage, car loans, credit card debt, down to about 7.5 years.
That's amazing.
No change in lifestyle.
Yeah, it really is.
Just keeping that income and expense ratio.
Hey everyone, it's John. I just wanted to thank you for being here, and I would ask that you please subscribe to the show by just clicking the subscribe button right here. I'd really appreciate it. It helps grow the show so we can get even more successful guests on the program to help you. If you're already subscribed, a huge thank you. When you subscribe, you're going to get access to the program before anybody else does. So if you would, just click subscribe right here. Thanks so much, and welcome back to the Wealth Easy Show.
Yeah.
Michael, Manulife One mentions playing the long game, and it takes a long-term approach using the Manulife One to work towards financial goals beyond just paying off your mortgage. Can you expand when you work with your clients how you use this part as an overall wealth building strategy? Because I know you're not just a mortgage broker. You know, you're implementing the philosophies that I even teach and I talk about is plugging your financial leaks and creating wealth. How do you use this to help create wealth for your clients?
So one of the strategies that we look at first, and I know Robert knows about this, is when you're implementing the Manulife One, you first take a look at all of their assets and their liabilities. If they have money sitting in checking accounts, savings accounts, TFSAs, RSPs, things like that, we all know those are poor choice for investments. So we consolidate the free cash from those into the Manulife One and pay down the balance right away. So now they have free access to some cash. And then we put the mortgage and debts in there and we show them how to accelerate paying that down. And the reason we take from all those taxable retirement benefits and we put them into something like this and get rid of those other investment choices is because of that word taxable. I know you teach on that a lot. We want to help them realize that there is tax-free solutions. So get rid of the stuff that in retirement is going to be taxed. Put in something like this, accelerate the pay down, and then look towards the future where it'll provide tax-free income. And during that process, as they're accelerating it and paying it down, again, keep in mind, because it's a two-way street, not like a mortgage where it's a one-way street. Mm-hmm. So every dollar they put into the Man One, they can pull back out again. So they can accelerate the pay down through their income and expense ratio. But as they're paying it off, they can draw from it and invest into other tax-free retirement vehicles like your cash value life insurance or multifamily real estate or other things like that, mm-hmm. right? So that's where you and I work together is I look at the whole picture, where they're at now, where they need to be or want to be in the future, how we can take what they have now and restructure it and put it into something that's going to give them better access to tax-free cash that then they can double and triple and quadruple leverage through other tax-free products and build up a tax-free retirement income.
I also noticed during the pandemic, and Robert, you've probably got this along a lot of the way, probably not with the Manu One product, but with other traditional mortgage products, is that during the pandemic, a lot of businesses were shut down. And I had clients calling me, and Michael, I'm sure you had people calling you too, and saying, hey, my business is shut down. I've got no income. I still got to pay rent. I've got to support my family. I've got $1 million of equity in my home. John, can you refi me? I need to do an equity takeout. I'm like, well, Mr. Client, if your business is shut down, where are you getting income from? The bank is going to want to see you still producing income. You don't qualify. And I get into an argument. It's like, guy, he goes, John, I've got $1 million of equity. I want to take it out. I'm like, Mr. Client, the bank wants to see income. If you have no supporting income, you do not qualify. How does this product differ from that product? It's an open, like you say, it's a two-way street, right? So, if we were to head into another lockdown, how would this product benefit those people who could not access or refi because they have no income coming in?
Well, I can tell you during the pandemic, we did not have one deferral payment with Man One. No customers had to defer because we're very picky in who we're taking. Most of the loan to values are under 65%. Technically, there is no payment required until you hit 65%. So people had complete freedom while their businesses were shut down or while they weren't working. They stopped or they pulled money out if they had to. So a regular mortgage assumes that nothing is going to change. A Manulife One will change as your circumstances change. And we saw that during the pandemic. And to your point, this is a product you never get rid of. You can't, if you're not working or if you're retired, you can't have this product. You won't qualify. So we look to people that are, in their peak earning years, let's say 50 plus, and maybe have no mortgage on their house. You have $1 million home. We can put $650,000 on it. There is no payment required until you hit that amount. So think of people that, with the cost of living, what it is today, people don't have savings the way they have in the past. Their home is their primary source of savings. They can create a structure, almost create an annuity where they're going to draw money out monthly. They'll know how many years they can stay in their house and how much money they can draw out each month. And that's the beauty of this product. It's not a mortgage, it's a financial planning strategy. And you can use it very much like a reverse mortgage. The fees are probably lower, and if you change your mind and it's all in the HELOC, there's no cost to unwind it. So there's a lot of different things you can do with this product.
Mm-hmm. I was going to say, Rob, you just touched on that, which is a good point, and I teach that to my clients too, is a traditional HELOC is a third-party bank registered against your house. You have your own bank account over here. It charges interest. You have to make an interest payment externally every month to pay that interest. With the Man One, if you make it your primary checking account, the interest accrues into the account, similar to a reverse mortgage. So that's when he said there's no payment required. Oh. If you have enough equity in, let's say you get 65%, $650,000 on $1 million home, and you don't owe anything on it to start. So it's all free, $650,000 cash. You can draw from that, and the balance will start to increase. And as they start to charge interest on that, the interest just accrues into the account. Until, of course, you get to the max 65%, then you start paying it back down. But all that time, the interest is accruing into itself, similar to a reverse mortgage. So there is never technically an external payment required. So for retirement planning, it's amazing.
I think this is a game changer for especially, retirement plans, because there's no requalification. If you've paid your home off, you're still using it as a checking account, and there's no requalification once you get into retirement. And you can actually, instead of taking the reverse mortgage, because we all know how those work, there are a lot of fees. And this has already been set up.
Yep.
And they can just start taking a monthly payment from it. And like you said, there's no payment required until you hit that 65% loan to value. But in the meantime, the value of the home is going up. Now, if they hit, here's a question, Rob. If they, let's say in 5 years, they started taking this thing out, and, the value of the home goes up. If they hit the 65% on what the home was originally appraised at, and now you're 5 years later, would you take into consideration the increase in the value of the home and get a new appraisal? Like, is this a new application, or you say, hey, listen, let's take a look at the value of your home and let's see if we can push the 65% out to the new appraised value? How does that work?
So the nice thing with Manulife is, because we're a Schedule I bank, we can do the increases internally. There's no breaking of the mortgage to redo it. We can just add the HELOC. We would do an appraisal and increase the amount. We would do it all internally. The client still deals with the broker. So in this case, if they're dealing with Michael, they would continue to deal with Michael, but we would handle it all internally. So you're right. If it goes up, we can absolutely do an increase.
Good. The materials in the Manulife One also mentions using it for financial planning, and says big differences, big rewards. And it notes that with the Manulife One product, you can borrow from the equity in your home, just like we were talking about, for things like investing in a cottage or funding an education. Can you share an example of how a client used this flexibility to further their lifestyle or their financial goals?
The product itself, it's been around for over 30 years. It actually originated in Australia. A lot of people call it the Australian mortgage. And Australia is very similar to Canada. People struggle to save. They want to get ahead, and cost of living is very, very high. It came to Canada because the CEO from Manulife was from Australia, brought it here, gave it to the advisors first. We've only been in the broker space for about 8 years, so we're still very young in the space, but it's really meant to accumulate wealth. Because you can pay your mortgage down faster, it's not you're going to pay your mortgage off and do nothing. You're going to do something else with that money. People can either buy new properties, they can buy rental properties, which we see a lot. And because the HELOC itself can have tracking sub-accounts, you can use that as a down payment to buy a rental property, track it separately for CRA, and then increase your wealth that way. You can do other investments. We've heard of cash damming if you want to create, take your non-tax deductible interest and make it tax deductible. So there's various ways you can do that. But it really was designed to pay your mortgage off quicker and accumulate wealth. And that's really what the product is designed to do. And we see a lot of that. I get calls almost every day, people saying, I've got this equity, I want to take $200,000 out, I want to buy a rental property. And as long as you're tracking it separately, that would be okay. You just don't want to mix it with your personal use. Right?
Yeah, Michael, I mean, I know you're really big on this with your clients, and you've just become a Grant Cardone licensee, and you're
Yep.
teaching people about multifamily and real estate investing. What unique opportunities have you found using the Manu One product for your clients to get into the real estate market?
Well, for real estate specifically, that's what Robert was touching on there, is that as they pay down the Manulife One balance, because it's readvanceable, they can pull from that, put down payments onto other things. They can invest it into multifamily, they can invest it into duplexes, triplexes, rental properties, and put a down payment down, finance the rest. And now that interest, because they've pulled from their Manulife One and put it into a cash flowing external real estate property, the interest on that now becomes tax deductible as well. So it's already a tax-free income withdrawal that they can use to put towards the down payment. But now the interest itself is tax deductible against that rental property if you track it in a sub account, like Robert was saying.
Mm-hmm.
So it's very, very flexible. And the bank statements that they get every month, they're super clear and they're broken down very easy, where you can see each account and the interest it's paid, and you can just hand that to your accountant every month and they can write off the interest for each property. So there's lots of ways they can do that. And then if you want to touch on the cash value life insurance, because I get people to do that as well with you. So because that life insurance product, as they accumulate wealth in there and the cash value is going up, after a while they can then borrow against that cash value. They can borrow against that and further accelerate the pay down of their Manulife One
Mm-hmm.
and pay it right off much quicker, and then reinvest that new income back into the policy to pay back the cash value and then go invest into real estate. Like, there's multifaceted approaches that you can take.
Yeah, Robert, there's well, the law right now is you can only get a HELOC up to 65% of the value of your home. So there's going to have to be a portion. So your client puts 20% down. So is the remaining 15% in a traditional fixed mortgage?
Correct.
Okay, but then there's also a sub account. But that only 15%. So if the guy buys $1 million home, he's got an $800,000 mortgage. Only 15% of that is going to be a mortgage. So really, he's going to be paying a lot less interest over time because he's only paying interest calculated in advance on the 15% and the 65% as a HELOC. How many sub accounts can you have?
You can have 15 sub accounts in this, so you can have up to 15. Yeah.
And why would someone have that many sub accounts? Because you talk about, you could use these for emergency reserves and other types of accounts. Why would someone have 15 different sub accounts? What would they be used for?
Yeah, I've seen people have 5. They've taken a 1 because they don't know where rates are going. So they took a 1, 2, 3, 4, and a 5-year terms. They've kind of laddered their debt because they really didn't know where rates were going. So we've seen that happen a lot. But the nice thing is you have flexibility. So the HELOC right now is at 7.7, which again, sounds high, but if you have the freedom to pay it off, that kind of mitigates that risk. But if the rates do drop in the future, you're free anytime to take part of the HELOC and convert it to a locked-in portion. I don't think we're going to see rates as low as we had in the last decade, but if the rates do drop and they say, oh, the 5-year rate is really attractive, I'm going to lock a portion of that up, they can do that at any time without penalty. So they do have freedom to go back and forth. But again, if your cash flow is good, you're always better off in the HELOC, not in the sub accounts. Are just amortizing portions. We call them sub accounts, but they're just amortizing portions.
Okay. So the HELOC is calculated. It's a half a point above the prime rate.
Right.
So it does fluctuate. So if the prime goes down, then this is also going to go down too. And you're saying so that 15%. So if someone wanted to ladder their debt, they could do different accounts. Like they could do 5% in 1 year, 5% in 2, and 5% in a 5-year, that sort of thing.
Yeah, absolutely. And we incentivize people to use it the right way. So if they put 25% in the HELOC, we'll give them better rates on their fixed rate portion because we want people to use it the right way. The analogy I always use is if you have a really nice sports car and you put regular gas in it, it's still going to work, but it's not going to work as well as if you put premium gas in it. You want the product to be used the right way.
Right.
And that's why we'll give them a better rate on their fixed rate if they put at least 25% in the HELOC.
It's some people like you and I know this.
Yeah.
They hear one thing, interest rate. What is the interest rate? And they forget about the product and what the product can do. And they hear interest rate, and someone's going to hear this and go, oh my God, 7.5 or 7.7%. That's
Yep.
so much. I can get it fixed at 5.69.
Yep.
But let's talk about the difference. That 5.69, let's look at we talked about this when you were my guest before. The cost of money.
Yes. That's what people miss,
right?
right?
It's the cost of money, because you could look at, okay, I've got a 5.6 fixed rate, but if I take a look at the amount of interest that I'm paying in the first year versus what I'm actually paying into a principal, the cost of that money sometimes is over 80%. When you talk about, Robert, having a 7.7% interest rates, that's simple interest. What can be the difference between the simple interest and someone having a 5.6% fixed rate and the interest on that? Let's talk about the cost of money, because people, they forget about that component.
Yeah. Well, what we have, and the nice thing about this product is I don't think it has to be sold. Money Sense magazine 2 decades ago, in their issue about the top 50 ways to grow rich in Canada, number 25 was get a Manulife One. We know it's the best product for the right client, that we don't have to sell. So the nice thing about it is we look at the calculator. We look at all their expenses. There's 14 data points that we look at. Then we plug everything into the calculator. If the numbers work, it'll tell you exactly what your 4.89 is going to, how many years it's going to take you to pay it off, how much interest it's going to cost you, versus having it all in a HELOC at 7.7. And generally, again, I've seen 25-year AMs cut down to 10 years. I've seen $100,000 in savings. It's just looking at the data, but the data has to be accurate. People don't tend to budget, so we need to know an accurate. So as a broker now, you're not just talking about rate, you're talking about cash flow, talking about expenses. We'll consolidate your expenses, find out exactly what you're spending every month, and then we'll compare. And if the numbers work, then the clients say, well, I guess rate's not that important if I can save $100,000 in 10 years in payments.
Michael, are there any tax strategies that clients should be aware of when using the Manulife One product, particularly if they're leveraging their home equity for investing?
The first thing, I guess, is mainly for self-employed clients, because if you have an incorporated business, you can leave money in the business and pay less tax through the corporate tax rates. You can pull money out and pay tax on that. But if you can pay yourself less out of the corporation to pay less tax, manage your cash and expenses, and pay down the Manulife One, use the Manulife One to inject a shareholder loan back into your corporation, have the corporation buy into a corporately owned whole life insurance policy, or you have a holding company and that holding company invests into some real estate, you're cycling the money through more tax efficiently, saving on income tax, and getting the benefits of the growth in the insurance or the real estate. So it's more like how you cycle the money through. That's where it's really going to help. Or if you're just an individual who's employed, as you accelerate and pay down your Manulife One, you can pull that money out, like we just talked about, put a down payment onto an investment property. The investment property is a tax advantage on its own, and now the portion of your Manulife One that you pulled out is tax deductible. So you're going to pay less tax and reduce your overall tax burden while growing wealth.
And let's just be clear for our listeners, CRA has some very strict rules on what can be used to deduct income or interest. And I know one of those rules is if you are taking money to put into investment purpose, that investment has to have an expectation of profit, produce interest, or produce a dividend or a capital gain for you to be able to deduct the interest. Robert, you talked about the sub-accounts. Should someone, if they're going to use this, the HELOC to do some investing, should they set up a separate sub-account for a paper trail? Because Revenue Canada is very clear. They want a very clear paper trail on what's being used and how to deduct the interest. Would this be a sub-account that they can set up to track the investment?
The first thing we say is you always check with your accountant. Always check with your tax expert when you're doing any type of this investing, because you're right. It's kind of a gray area, writing interest off. We can track it separately. It's still part of the HELOC. It's not going into a fixed rate. It would still be part of the HELOC, just tracked separately. but always, always, always check with your accountant and make sure that everything is fine, because you're right. You have to have a paper trail and you want to keep everything as clean as possible. And I'll just circle back a little bit to rental properties, because the Manulife One works really well on rental properties as well. Because remember, it's a bank account. So if my rent is coming in, my rent checks, and I'm in a surplus, it's all going into that Manulife One rental property account. So again, it's clean. Yeah, it's all contained. If you want to do renovations to the property, you can do that. So Manulife One works really well on the rental side as well.
So that's a good point that you just brought up. So just clarify that for the listeners, Rob. Can you put a Manulife One on a rental property?
You can. And again, because it functions like a bank account, it becomes turnkey for you. And so in terms of Revenue Canada, it's all contained. The money goes into that account. Any renovations you do, money is pulled from that account. So it's very clean to do it that way. So I'm a big fan of having a Man One on a rental property.
And that's a really great example of rinse and repeat. If you're doing it on principal residence, do it on your rental property and have those rent checks go into that account.
Yep.
And now you're reducing the principal each month by that amount that the rent comes in. And it's like, rinse and repeat, and just keep doing that. That's brilliant.
Yep.
Robert, how can someone use a Manu One product as part of their estate planning or intergenerational wealth transfer?
Good question. There is right of survivorship with it, but again, it's not really an investment. It really is still, it's a bank account and a mortgage. So I'm not sure I'm the qualified person to answer that question for you, but I'm sure there are ways you can do it, but again, you'd have to check with an accountant on that.
Mm-hmm. Are there any situations where a client may not use a Manu One product and choose a traditional mortgage over the Manu One instead?
I would say if their cash flow doesn't support it, we have a nice pathway to a Manulife One where you can get a traditional insured and insurable mortgage and then convert it to a Manulife One down the road as you pay it off. So let's say someone is, they're 20% down or they're even 10% down. They're properly suited just for a regular mortgage, getting the best rate. But then as they pay it down and they decide they want a HELOC, they don't have to get rid of that mortgage. We can essentially convert it to a Manulife One and do it that way, so they can avoid penalties and the hassle of having to redo their mortgage. We handle that all internally. Again, it's all handled through the broker. The broker is still the main point of contact, but we have the ability just to convert those we call them select mortgages, just regular insured and insurable. We can convert those to Manulife One internally.
Right. And just for listeners, just to be clear, you cannot use the full Manu One if you are just putting 20% down. If you need an 80% LTV, you can only use up to 65% of the Manulife One product as the HELOC, and the other 15% has to be set up as a traditional mortgage. But like Robert said, you can have separate sub-accounts and you can ladder your debts, just like, I talk about bond laddering or GIC laddering,
Yep.
right? 1 year, 2 years, 3 years, 4 years out. So you've always got something that's coming due. You could do the same with your mortgage product, true?
Yep.
Okay. Mike, what advice do you give your clients on how to ensure that they use the product responsibly and they get the most benefit from this product?
So I know Rob touched on that they can keep their existing banking and linked accounts and send money into it. Mm-hmm. I teach them that it's more efficient and better if they just make it their main bank account. They don't have to close their other bank accounts if they bank with RBC, CIBC, whatever. They can keep those as just emergency checking accounts, but they need to make the Man One their main account. So that's the very first thing that I teach them that they need to do. And then once they're making it their main account, I sit down and I spend the time to go through an actual budget with them, set it up on paper, write it down so it's clear with them. We get 2 or 3 months of bank statements. We go through the whole thing. We get a clear budget picture. And then I just hammer it home and I say, if you want this to be as effective as it's made to be, you need to look at not the day-to-day picture. You need to have the broader mindset. You need to set the goal of 5, 7, 10 years. We're going to be debt-free. And you need to think of that goal every day. And by doing that, you need to keep your income and expenses at the gap we have now or better and manage those expenses and just live within your means with the mindset that you will be debt-free in the future and you will be growing long-term wealth. And I just hammer that home, and I hammer the income and expenses home. I set a budget with them, and I really just teach them, don't get carried away and think of this as free money just to go blow on crap. Because if you do that, this whole situation is meaningless. You have to look at it in the broader sense. And so as I educate them and I keep in touch with them, check in on them, see how they're doing, give them tips and advice along the way, hook them up with podcasts like yourself where they can learn tips and techniques on growing wealth. I've had a great track record with my clients. So
it sounds like this is going to be really good for someone, though, who has extra money at the end of the month, that they're not living hand to mouth every month.
yes.
Right? Because they're each month they're leaving a bit more and a bit more and a bit more money in this. Robert, in your experience, you've been with Manulife One for how many years now?
Not even one. It'll be one
not
in
even
July.
one.
It'll
Okay.
be 1 July 4th.
Okay. So 1 year.
Mhm.
In your experience, have you seen a change in people's mindset that, you know, they're a little iffy going into this, but once they start to see the acceleration, are you noticing a shift in the mindset that, hey, I want to dump more and more money as people start to see the mortgage account dropping, that they actually start really using this as a full check account and they start putting all the resources in? Because the way I see this, if I was someone, I get excited, you know, when I see my savings account, and I pay myself first. Every check that I get that goes into my bank account, 20% comes off the top, and I have a side account. And once I build that up, I either dump it into my life insurance policy. I've got 3 policies, and I save up for my annual premiums. And then when I have a big extra surplus, I get excited every time I see that growing and growing. I think the reverse would be true, no? That when they start to see the account balances, are you noticing a shift in that mindset where people are dumping more of their resources into it?
Some of the earlier clients, I get feedback from brokers all the time, and a lot of them are apprehensive. So they lock money up into a 3 or 4 year, and they get their main account as well. And the feedback I'm getting from brokers is because the statement they get every month shows them how much principal has been paid off, but that's from the HELOC. It's not from the amortizing portions, because that's on a schedule and that's not going to happen that quickly. But the feedback I'm getting from brokers is the client says, I can't wait till this 3 year matures because I got to get it into the HELOC because I got to get back on track getting this thing paid off. And that's what we're seeing with clients. And that's exciting when they see that, because if we can give them that feedback every month and say, this is how much principal you paid this month, let's see if you can beat it next month. And it becomes like a game for the client. And they now say, I can attack the mortgage. I can see the principal coming down. And that's a huge motivator for clients, instead of saying, you know, getting your typical statement in January of every year and seeing how much interest you paid and how little principal and saying, oh, well, that's the way it goes. But it doesn't have to be that way. But clients have to be motivated to pay their mortgages off. They really do.
Well, I remember, you know, when I used to have mortgages, I mean, I rent now. I own real estate, but I rent where I live. And I see that mortgage statement, and you get this massive payment, and you see, yeah, you paid $35,000 in interest, and you paid about $5,000 in principal, and you're like, "Fuck me, this is ridiculous."
Yes.
It's so depressing.
Yeah.
But I see the reverse, that with having a change from simple interest over compounding semi-annual interest, you really see a huge chunk coming off that mortgage. Mike, what are you seeing with your clients? How long have you been using this product for?
Well, we've been using it since I started in mortgages 15 years ago. But what I've seen the shift is that for all those years, brokers were just selling it as a HELOC. They weren't educating people on using it properly. If you just leave it as a HELOC, it's meaningless. It could be any other HELOC. But if you use it properly, it's so powerful. And I have seen a shift lately as I teach people the true power of it. And it's funny because society, the middle class, has been trapped for years in this mentality of scarcity, right? to get ahead, I need to stop my Netflix accounts and stop going out for dinner and stop doing this and live as tight as I can.
That's the scarcity mindset.
Save as much as I can into my savings accounts, and one day I'll get ahead, right? And so as part of that scarcity mindset, when they come to a mortgage broker looking for their mortgage for a renewal or a purchase or whatever, their mindset is, I need the cheapest rate. Because to them, in their scarcity mindset, the cheapest rate, the number on the page, makes them think they're saving money, right? Mm-hmm. And in the scarcity mindset, they need to save money everywhere they can. That's the only way they're going to get ahead. So by educating them, showing them the possibilities and the tools and tricks that the wealthy use, and showing them there's a way out of the middle class, but it's not thinking the way you're thinking right now. It's flipping that and realizing that the number doesn't mean anything. It's how that number goes to work for you. So as you said, a 7.7 versus a 5.6, the middle class scarcity mindset is, I want the 5.6. The wealthy mindset is, screw that, because the 5.6 over 30 years is going to cost me $500,000 in interest. Mm-hmm. The 7.7 over 7 years is going to cost me $100,000 in interest, right?
Stop focusing on the number. You got to take a look at the product. And that's the great thing about being a mortgage broker, is that we educate people. It's not all about rate. It's about product. What is your intention? What is your goal? What do you want to do with this? Yeah. Stop focusing on rate.
And it's such a massive shift, because the banks and the government have spent so many years and so many billions of dollars on advertising to keep the middle class down. Mm-hmm. That's why we see the gap between the middle class and the wealthy growing, right? They'll blame it on the wealthy, but it's not. It's the banks and the government that are keeping people trapped in that scarcity mindset. So as we start to see that shift, we start to show people that there's a way out of that, and they don't need to stay trapped, right? But you gotta change their mindset. And for those that don't see it, it's clear when you're talking to them, and they just aren't going to get it. But for those that do, that light switch turns on. Mm-hmm. Like Rob said, they want to go all in, and then they'll challenge themselves month after month to beat their record last month, or they'll put more into it from all their other investments. Like they'll really hammer that thing down, because it's such a powerful tool to then use to grow future wealth.
Yeah. Rob, you've been in the business a long time. I'm gonna throw a word out there that will probably ring a bell. Smith maneuver.
Yeah.
Fraser Smith, 20, 25 years ago, he created the Smith maneuver, which seemed to be really good at the time. I had constructed a similar type product, and at that time I was using, I think it was National Bank. They had a re-advanceable mortgage. Are you seeing people use the Manual One product as a Smith maneuver type scenario or strategy?
I would say not a lot. I would think it's still a strategy that's for the most sophisticated client, and I don't see a lot of people doing that. I see a lot of people, well, I shouldn't say that. When it comes to like using it for stocks and for investments, probably it's a very a limited market, I think. But I'm seeing it a lot for real estate, because you can do a Smith maneuver with real estate as well, and I am seeing a lot of that. I think people have the appetite to buy properties. I think is easier for people to handle the ups and downs than they can handle the ups and downs in the stock market. I believe that. And that's just from being an advisor for 15 years and just focusing on investments. People are not comfortable when the markets are really volatile, the stock markets. But the real estate market, people seem to be able to hang on to that and be able to weather those storms a little easier. So I am seeing it, but more with real estate than stock market.
Well, I think it's a safer play, because,
Mm-hmm.
I like real estate. And if you take a look at over the last 40, 50 years, as immigration continues to go up, people need places to live. And there's only so many homes that are being built. There's only so much land that we have. I think the price of real estate can only go up.
Mm-hmm.
Whereas stocks, I just wrote a book called Wealth Without Wall Street. It just came out, and here's a plug for my book. Wealth Without Wall Street is now available on Amazon. And I talk about how you don't need to participate in the stock markets to create wealth, because if you listen to guys like Dave Ramsey and Susie Orman, and Dave talks, well, you can get a 12% rate of return on your mutual funds. I'm like, Dave, show me that mutual fund. I'll put all my money in there. What he doesn't seem to get is sequential rates of returns, that these mutual funds have high fees, and it's not compounding interest. When you invest into a stock, it's not compounding interest. Anything that can go backwards, you could lose money, is not compounding. Where, like what you suggested, Rob, is real estate, where the trend line over time does trend upward. It's not so volatile. And it is something that you can touch, and it is something that you can take equity. You can refinance and pull equity out. So I think if, using the Manulife One product, like you're talking about, and what you teach your clients, Mike, is as you build up the equity, take that equity and go purchase a rental property and do the same thing, rinse and repeat. Throw a Manulife One product on that.
Yep.
And keep revolving it and doing that over and over again. Do you have, Mike, since you've been using this product, what successes are you seeing? I mean, obviously, your clients have to be very diligent, and they have to be disciplined, because they see this massive HELOC as like, I've got all this money available. Let me just take this $10,000 trip to Sandals in Jamaica. It's the consumerism that kills people. What are you seeing with your clients? What successes are you seeing up till now since you've been using the product?
So part of my screening process, which might be different from others, but part of my screening process before I even put somebody into a Manulife One is I have to determine if it's the right fit.
How do you determine that? What would be a right fit for someone? Walk us through the sign-up process.
Yep. So as I'm interviewing the client and I'm discussing their life goals, their situation, their income, their expenses, their family, their future goals, their current situation, I'm determining not only how much they need as a mortgage, which is one thing you're trying to do as you're consolidating some things on a refinance, but I'm determining based on credit scores, past histories, future situations, current jobs, things like that. How good are these people at managing money? Are they coming to me in their 20s and 30s with $150,000 of credit card debt because they can't stop spending? Or are they diligent and they have RSPs, TFSAs, things saved up, and they just need a better product because they're not making the best use of their money? So really, it's people that have the initial bit of that mindset already, but they just don't know how to take it to the next level. Mm-hmm. I'm not going to stick somebody in with the risk that they're going to abuse it and it's going to make them worse off. So I really focus on mindset. And when I'm interviewing the client, you can get a handle on people right away and determine if they're the kind of person that's going to work with you, set those goals and targets, and then allow you to connect them with other like-minded individuals like yourself, financial planners who can help them move into future longer-term products, and real estate professionals who can guide them into buying investment properties and things like that. So it's a mindset thing. And as part of my interview process, I can pretty quickly determine if it's going to suit these people. I mean, it can be used by anybody with the right income expense ratios, et cetera, but you brought up the point. If they don't use it right and they abuse it, I've paid down $100,000. I'm just going to go and spend it on a Ferrari or whatever. That's useless and they're not going to get ahead. So it's about educating people and about seeing their personality profiles as I assess their situation and who they are as a person, and just determining if this person is going to fit one now, or if I need to get them a different product, work with them, get their mindset shifted over time, and transition them into a Manulife One. So my goal is always that I'm eventually going to get everybody into one. I talk about how many I want to sell, and Rob gets blown away. But I think it's my goal to educate everybody that's a client of mine to change that mindset and get out of the middle class. Stop trying to just think of just enough. I just need this and I'll be happy. I just need that and I'll be happy. I just need the right house and I'll be happy. I just need the right amount of savings and I'll be happy. Stop living in that mindset. Look at the possibilities that are out there. I mean, the world is full of money. There's no shortage of money in the world. You just have to find ways to get it, right? So I like to think that I'll eventually be able to educate every client and move them into that Manulife One situation and into the life insurance situation and the real estate situation and help them move through life into a brighter future. So,
yeah, I think anybody who gets into this, number one, you have to be disciplined.
Yep.
It's not an open account to spend on consumerism. Robert, we're going to wrap this up in a few minutes, but I want to talk to you about interest rates. The economic numbers just came out yesterday, showed that the GDP, or sorry, not the GDP, but the inflation fell down to about 2.7%. Do you see a move by the Bank of Canada anytime soon? Does this actually make a stronger case for them to reduce the interest rate and cut the prime rate?
Yeah, I'd like to see a quarter point in June. Hopefully we get it, but if we do, great. If not, then we just carry on. People seem to have adjusted to these higher rates. I think a quarter point is more of a psychological drop than anything, and it might spur the market on again. So hopefully we do see it. We do see the quarter point in June, but we'll have to wait and see.
But do you think also the Bank of Canada is looking at, if the US doesn't do anything, that it's going to hurt our dollar if they cut rates?
It would, yeah. I mean, I'm sure they're factoring that in as well. Absolutely. I mean, I'm surprised at how busy we've been given the rates and given where they are. Because remember, people getting a 7.7 are qualifying at 9.7, and we're extremely busy. I mean, I'm seeing over 100 submissions a month. Wow. So it's very, very busy. Yeah, it's extremely. So we're happy. I mean, the business is good. It will only get better as rates drop. But again, this product is not driven by rates. It's only driven by cash flow. If your cash flow is good, the rates, it doesn't really matter.
Robert, final thoughts on this product. Anybody listening, what are your final thoughts to them regarding this product?
I've always said this product is sold by exceptional brokers to exceptional clients. And again, if you're just selling rate, you know what, that can be shopped all the time. People can, if they're calling you for rate, they're going to call the next broker and the next broker. This is a strategy. So if you're talking about this product to a client, you're really trying to change their life. It's a much more difficult sell for the broker because they really have to act like a financial advisor, right? Think of a financial advisor for stock market investments. A broker is really a financial advisor for their liabilities. Mm-hmm. And people really need help in this space because we're falling short. People are not paying their mortgages off. So the mortgage broker that's selling this product is they're really exceptional brokers. They're really going that extra mile. They're involved with their clients. They're not just selling them a rate and then they're going to talk to them again in 5 years when it's mature. They're going to be coaching them along the way so they have a much better relationship with the client and really helping them get ahead. Like when Michael's speaking, he's very passionate about this product and he's really out there to help people. He could just sell rate because it's a heck of a lot easier for him to do that, but he's not. He's taking this approach and he's doing really, really well. And I believe him when he says, what his goals are, I believe he's going to do it. And the more people that get this product, the right people that get it, the further ahead they're going to be. And that, to me, that's what it is. It's just about education. It's not about trying to sell anyone. Just get the right product, pay your mortgage off as fast as you can and build wealth. And that's really what it is.
And Robert, that's a really good point. There's thousands of mortgage brokers out there, and most of them are transactional.
They are.
Right. Very few are like Michael and myself who say, hey, let's not just focus on the rate. What is it that you're looking for? Tell me about your lifestyle. Tell me about your goals. What do you want to see happen? And we structure a product around your goals and what you're looking at, because it's not all about the rate. Mm-hmm. Mike, final thoughts?
Yeah, I'm just very passionate about changing the lives of so many people and seeing them get out of the cycle they're trapped in and realizing the potential that's out there with the right education and the right products. So I'm just very passionate to keep using this product to change people's lives and then connecting with guys like yourself to see people grow wealth.
Yeah. And for my listeners, guys, I didn't do this show to plug Manulife. I'm not here to promote Manulife. I promote creating wealth. And the reason why I had Robert and Michael on the show talking about the Manulife One product is because they are a standalone company that's actually doing this. And it's not about promoting a bank. It's about promoting how to create wealth. And by you being able to reduce your mortgage and pay it off in 7 to 10 years, that is going to create more wealth for you, because these are payments that are not going to be directed to the traditional banks who have you stuck in a traditional fixed mortgage where they're collecting all the interest up front. And, instead of having a $500,000 mortgage, you've actually paid $800,000 over 25 years. That is not what I'm here to promote. I am here to promote creating wealth and doing it efficiently and plugging your financial leaks. And I think the Manulife One product is just that. If you're looking to plug these leaks and save interest, guys, I think you should get in touch with Michael and figure out how you can get into one of these products. Michael, tell everybody how they can get in touch with you.
So my phone number is 705-331-6153. They can call or text me anytime. My website is momentummortgage.ca. Momentum being moving people forward. That's our motto. And my email is michael@momentummortgage.ca.
Fantastic. Folks, that's all the time we have today. Robert, thank you so much for your time and being on. Michael, thank you for making the trip here. Guys, if you like this episode, please like it. Please share it with friends who you think may benefit from this. And please go to Amazon, pick up my new book, Wealth Without Wall Street, and please leave a review. It helps build the algorithm. That's all for today. Take care of your wealth and your health.